Hello everyone, hi, welcome to the channel of Wall Street Mojo. Today we have a topic with us is temporal method. We'll try and discuss this. This is the accounting method. We'll try and discuss this in a very detailed format. At the very first and the foremost stage, we'll try and discuss what is the temporal method. No, shoot. See, the temporal rate method or the historical rate method is employed, to convert the financial statement of the parent companies or foreign subsidiaries from its local currency to its reporting or functional currency. Okay, to its reporting or to its functional currency when the functional currency and the local currency are not the same. So temporal method is also utilized at the time of the what we call as the acquisition, okay, of the asset or liabilities. Okay, so the temporal method entails a majority of the assets and liabilities to be evaluated through the utilization of the rate of exchange in effect at the time of creation of a particular asset or liability. So only those liabilities that include a fixed foreign currency value are translated at the prevailing current rate of exchange. Now, the rate of exchange that has been used, the rate of exchange that is used in dependent upon the valuation technique is being employed. It's like for assets and liabilities that are valued at the current prices and the present rate of the exchange is used. So on the contrary, the liabilities is valued at historical prices. Liabilities is valued at the historical prices involves utilization of the historical exchange rates. Now, income generating assets, okay, like proper inventory, plant, equipment, are updated regularly to reflect the market values through the utilization of the temporal method of currency translation. So, the profits and losses are as a result of the translation and it directly goes to the consolidated income statement. Now, due to this, it affects the consolidated earning regularly, making them rather more volatile. So, according to the FASB rules, as per the FASB rule number 52, you also can apply to the temporal rate method if the operations at your firm are carried out in exceedingly hyperinflationary environment. Okay, now I'll take you to the example part. Now let's take the detailed example of temporal method. Consider that a company is based in UK that acquires, let's say, 70% of the share of the capital of another company based in Kazakhstan, where the native currency is KJS. Let's name the acquiring company as ABC and the acquired company as XYZ. Now, ABC over here acquires 70%. How much? 70% in XYZ. Now, ABC paid, let's say, £2,600 for acquisition of XYZ. That is the 70% share capital. So, for acquiring the reserves of the XYZ, ABC has to pay down a sum equivalent to 3,200 at the date of acquisition. Right now, consider this following rates that will apply to this particular thing. At subsidiaries acquisition, the rate was 7 TJS, 6.1 during the acquiring fixed assets. On 31st December, it was 5.6. Average was 5.1. On the year of acquisition, it was 4.6. And on the date of dividend payment was 4.9. So this was different exchange rates that were there during the different time frame. Now, the P&L statement of that XYZ company looks something like this. It has sales, cost of goods sold, depreciation, which comes down to gross profit, then distribution cost, admin, and finally with the PAT numbers. So now the following table, which will show the which rate will apply to each of the above item as per the temporal method exam, and what will be the value of the pound value of each of this item applying this rate. So the sales will be recorded over here. That will be at the average rate. Okay. Cost of goods sold again at the average rate. Now for depreciation, we will take the when the asset has been acquired. That is the rate that should be taken. Now gross profit is going to be just deduct your sales minus cost of goods sold and depreciation, right? The distribution cost over here will be recorded again at the average rate. Admin expenses, the same will be recorded again at the average rate. Profit before tax is just deduction of all the details. This is very important. The tax will be as per the December at the rate that has been used at the end of the year, 31st December of the acquisition. That is the rate that should be used. So I hope you have got the idea regarding what rate should be used where and how. Right now, I'll take you an item wise treatment. under the temporal method. See, the conversion of different balance sheet item and non-balance sheet item under the temporal method for foreign currency translation includes some item-wise nuances. Now, the conversion is done on the basis of various exchange rate and rules for that particular item. So, some of them and with the rules are as follow. The first is the non-monetary items. So, items that are reported on the historical prices are translated utilizing the historical exchange rate that existed at the time of the assets that were purchased. So when the assets were purchased, and such items like inventories, fastened assets, and intangible assets, and so on and so forth. Then we have the monetary items. Monetary items, well, translated by the use of the currency exchange rate, they include receivables, right? That is account receivables, accounts payable, long-term debt. Okay, then you have alternative assets, alternative liability, that are all measured in currency outside of the general exchange rates. Then we have the issued capital stock. Issued capital stock, so translated by using that rate that existed on the date of the issuance of the stock. Okay, fourth, we have the retained earnings. Okay, retained earning is not required to be translated. However, it could be used to balance the assets with liabilities, owner's equity. Okay, of the on the balance sheet date. Fifth is the balance sheet items. So expenses coupled with specific non-financial balance sheet items are translated in the way that includes COGS, then it includes depreciation, amortization, and so on and so forth. Sixth goes with non-balance sheet item. Now, sales and fee expenses are translated by using the weighted average rate of the exchange at the time of the accounting. Now, I'll take you to the next point of discussion is exchange rate used for the temporal method. Now, when we try and analyze this, these are certain exchange rates that are included in the translation methodology used in the temporal rate method of currency translation. So, these exchange rates are used are first one I'll try and discuss is the current exchange rate. Now, when we talk about current exchange rate, it is the rate of the exchange which exists on the date of the financial reporting. Then we have called historical exchange rate, which is the rate of the exchange which prevailed on the date when the specific transaction took place. Third one is the weighted average exchange rate, and in this scenario it is the rate at which it captures the changes of the rate of exchange over the long accounting period. Got it? So based on all of this, let me make my final conclusion on this method. See, as a result of the rapid globalization of the market and companies in almost all the nation around the globe, the business are not dealing in just one currency or one native currency. They need to deal with variety of currency on a very regular basis. So this is why the foreign currency translation becomes something which cannot be avoided. The several methods are designed to ensure consistent foreign currency translator, and temporal method examples is among one of them. The accounting standards which incorporate the foreign operation, okay, to use the temporal of historical rate method in case where the native currency differs from the functional one. Therefore, a subsidiary of a Canadian company with the foreign operation in some small country where all the business transpires in US dollars, so not the country's native currency, would use the temporal rate method. Now, once you apply the temporal rate method, you update the income generating assets on the balance sheet and related what we call as the profit and loss statement item by using the historical exchange rate of transactions dates or from the date of the organization's last assessed the fair market price, and you acknowledge those adjustments as current earnings. So that's it for this particular topic. Thank you everyone for joining the session.